Hey guys, I hope you are having a good week or have had a good week. Last week was a jam-packed week at New Money, New Problems, but it finished with our Black with Equity webinar. So to finish off Black History Month, you might have seen if you follow our newsletter or if you follow us on socials that we were having a webinar to celebrate Black History Month, to end Black History Month, but to highlight the wealth building opportunity of employees who have equity compensation through their employer. And as is often the case, when we have a webinar, we make sure that we post snippets that we think are valuable to our general podcast listening community. If you want to hear the full, unedited, unsnipped version, then you can join and access our private podcast feed by being a member of our newsletter community. So if you haven't already, you can go to newmoneynewproblems.com/subscribe, and in some of those introductory emails, you'll get a link to access our private feed that has the full webinar as always. I got to tell you before we get into this, something that really just grinded my gears, for lack of a better term. We tried to run ads on Instagram for this webinar and on Facebook to celebrate Black with Equity, to highlight it and invite people to come. And those ads were rejected because they were considered discriminatory. The person who reviewed the ads said that because we were inviting Black people and highlighting that we were inviting Black people, we were thus discriminating against non-Black people, even though we made it clear that all are welcome. It was just something that we wanted to highlight. That is something that I think is absolutely ridiculous, and I'm going to step out on a limb and say that if you're listening to this, Black, white, Asian, Latina, indifferent, and you don't think it's ridiculous, I'm going to just politely ask you to not listen to this podcast anymore, because it really, really pissed me off. That said, if you decide to keep listening, I hope you enjoy this webinar snippet. This is something, a topic, that being equity compensation, that we're going to cover more in more detail in future episodes. We don't want it to dominate the podcast timeline in terms of every week in a traditional series, because not everybody has equity compensation, but we're going to try to sprinkle it in to our regular content as best we can. So I hope that you enjoy this brief introduction, the snippet from our Black with Equity webinar. I will see you next week. All of these terms are going to venture into each form of equity compensation that we cover, starting with restricted stock. Restricted stock, in my opinion and in my experience, is one of the most common forms of equity compensation that you're going to come across, especially with already established companies. So it'll be different if you're working with a company that hasn't gone public or is public but is very small. In that case, you might be more inclined or likely to get stock options. But if you're in a situation where you have a really, really established company, an Airbnb, an Amazon, an HCA, an Alphabet, it's likely that you're going to get stock units, restricted stock. Now, how does this work? The first terms that I want you to understand for restricted stock is grant date versus vest date. And the best way to think about restricted stock is a type of benefit that I call a will be yours benefit. Meaning, if I stay at this company long enough, whatever restricted stock I'm supposed to get, I will get those shares. It's not a question of if, it's a question of when. And those questions are answered by the difference between the grant date of the shares and the vest date of the shares. And that also speaks to when the funds will be taxed. The grant date for restricted stock is when the company promises you the shares, not when they give you the shares, when they promise you the shares. So if you start a new job today on February 27th, and on February 27th, they say, we are going to, at some point in the time in the future, give you 1,000 shares of company stock. Well, February 27th is the grant date, but at that date, the shares are not yours and they have no tax impact. Right? They haven't been delivered. So just because they said eventually we will doesn't mean that you have to pay any taxes. The vest date occurs when you actually take legal ownership of those shares of stock. And any date where you receive legal ownership of those shares, on that date, they are taxable to you as ordinary income based on the value of the shares. An example would be if a company says at some point in the future, on today, we're going to give you 25 shares of company stock worth $25,000. Well, today it has no tax impact. But if 6 months from now they give me those shares and I actually get ownership, then on that date it looks like I earned $25,000 of cash, even though I didn't receive that money in my paycheck. So, grant date versus vest date. Now, this is really important. When you have legal ownership of those shares on your vest date, your W-2 that you receive every single year, it should in some way reflect the value of the shares that vested in that previous year. And we're going to show you where that's reflected on your W-2. Let's go through an example. Let's say that we have 1,000 shares of company stock and it's granted to you on January 1st of 2026. And on the date that those shares are granted to you, they're worth $250 a share. So this can change, right? Stock prices change, but at the date of grant, this is $250,000 worth of value. This is a pretty big deal. Now, they set up the vesting schedule based on the year in which you work. So this is a common vesting schedule. You might see that 15% of those 1,000 shares vest at the end of year one. And if you're going off of the current market value of those shares, that's $37,500 worth of value. You might see that 25% of those shares vests at the end of year two, and maybe 30% vests in each of years 3 and 4. So you can see at the very beginning of this why this is valuable to the company. They are promising you shares at some point in the future, but in this agreement, you have to be at the company at least 4 years to actually get those shares. And not only that, they have tilted the vesting schedule so that you get the majority of those shares in years 2, 3, and 4. So if you have somebody who at the beginning of this says, oh my goodness, I have $250,000 worth of stock that's just been granted to me, but they quit after year one, well, they're getting significantly less value than if they had stayed even to the end of year two based on this vesting schedule. Now, the important part is we talked about the value of this offer at grant, but you will not know the actual tax impact of these shares until they actually vest. Because if you have these shares that are granted to you at $250 and when they vest, they're worth $30, that's a radically different tax impact depending on the amount of shares that can vest. And it leads to one of the first pain points when it comes to restricted stock. Let's go back to our tax tables, and we're going to use an example of a single filer who has a taxable income of $200,000. If you're looking at the federal tax brackets for a single filer, this puts them like right on the cusp of the 24% tax bracket. Almost just a stone's throw of income could knock their highest portion of income into the 32% tax bracket. So if they're at 200,000, let's say that in that same year, they have restricted stock that vests at a value of 37,500, and it pushes their taxable income firmly into the 32% tax bracket. Well, if you're keeping track between those two tax brackets, 24% and 32%, this person has now had $100,000 plus of their income that's taxed at either the 24% bracket or the 32% bracket. Why is this an extreme problem when it comes to restricted stock? Well, the problem with restricted stock is even though this person has a lot of their income taxed at 24% and 32%, with restricted stock, it's considered supplemental income. And with most employers, supplemental income withholds taxes at a flat rate of 22% up to $1 million. So if you have someone who has restricted stock that vests, and they should have withheld 24 or 32 or 35 or 37%, the company's only withholding 22%. So that means that you could have a 2% difference in terms of underpayment. It could be a 10% difference, a 13% difference, in some cases a 15% difference. And when people get a tax bill at the end of the year and they're confused, the most common form or common culprit when it comes to restricted stock is we can point and we can say, hey, the highest portion of your income, your marginal tax rate is 24% or 32%, but they didn't withhold enough taxes on these shares, and that's why you got this tax bill. So what's a solution? One solution is you could simply go to your employer, you could go to the brokerage company that has the shares, and you can say, hey, when these shares vest, I want you to withhold more taxes. I want you to withhold 24% or 32%. The other alternative is, instead of increasing your withholding, to pay quarterly estimated taxes. Because if you have a proactive tax strategy and you know or can estimate how much you might have under withheld, then you also can estimate how much you can pay to make up the difference. So every 3 months, I'm going to give the IRS this quarterly estimated payment to make sure I'm not stuck with a surprise tax bill throughout the year. This is the difference between reactive tax planning, where you don't know where your taxable income will fall and it's all a surprise, and proactive tax planning, where you have some estimate and you pay in advance so you're not surprised. Let's talk about how that can be leveraged. The first thing when you talk about grant date and vest date is understanding that when you are accepting a job, when you are doing reviews for a job, and even when you are negotiating severance, the amount of shares is negotiable. I want 1,500 shares instead of 1,000 shares. The vesting schedule is negotiable. I want 20% to vest in year one as compared to only 15%. I want the majority of these shares to vest in the first 3 years instead of the first 4. That's a negotiation tactic. Even at severance, you can look and you can say, hey, you're severing me from employment, but I have 50 more shares that were due to vest in the next quarter. Can we push out the date that I was due to be severed and terminated past that date so that I can receive that on my agreement? And that is very, very easy to negotiate because it's stock that they already set aside. It's not new money to the company. When they give you a granted stock, they have to put that separately aside from their commingled stock as a company owned stock. So that means that somewhere there's those shares that have already been promised to you, and you're just asking them to extend out your severance date so that you can get that money that's due to you, which is different than them having to take money out of their pocket in this negotiation to give you fresh severance dollars. This is a common negotiation tactic. And in terms of using it for your portfolio, we're going to talk about overconcentration at the end of this presentation, but you always want to make sure that you have a strategy for making sure that you know when and how much of your company stock you're going to exercise and sell, in many cases to diversify it and lower your total portfolio risk. Next, let's go to stock options. And in this case, there's multiple stock options. There's non-qualified stock options. There's incentive stock options. What I would say is, if you have incentive stock options, it's because you are either like C-suite or you were like on the ground floor of when this company was founded. If you are in that scenario, we're not going to touch on those today. I would encourage you to, at minimum, if you have incentive stocks, you need to be working with a tax professional. That would be a scenario where I would also encourage you to work with a financial professional. What is more common for the rank and file employees, even high income earners, is to have non-qualified stock options. And that's what we're going to talk about in today's presentation. So non-qualified stock options, that's what it should say at the top, they have a grant date and a vest date as well. So the grant date for stock options is very different in terms of how they work. A restricted stock is a will be yours benefit. If you stay at the company long enough, you will have those shares of stock. A stock option is a could be yours benefit. What it means is you are going to be in a position where at some point in time, you're going to have the option to buy company stock, but you have to buy it. It's not given to you. And only if you choose to buy it will it actually be yours. So if you look at the difference, the grant date is when the company promises the option to buy, but the options can't be exercised until they vest. And on the vest date, if you choose to exercise, there's no taxation at vest to just have the option. You only have taxation if you actually exercise the option and buy the shares. Now, there's some other terminology, and we're going to give you an example so this will make sense. Additional terminology for stock options include things like the strike price, also known as the exercise price. So the whole point of a stock option is not just that you can buy company stock, it's that you can buy it at a discount to what the stock is actually worth, also known as its fair market value. So when you have a stock option, they're going to give you how many shares you can purchase, and they're also going to give you the price at which you can purchase it, which is called the strike price or the exercise price. Now, if you actually exercise those shares and there's a discount or a difference between what you paid and what the stock is worth, That is called a discount element. So the discount element is something that's taxable at ordinary income rates. It's as if you earned the money as salary. So if you're looking at the strike price and the discount element, the last thing I want you to know is called the exercise window. And the exercise window is how long you have to choose to buy these shares. Typically, you're going to have an exercise window of 10 years, or if you leave the company, within 90 days of leaving the company. So an example that you see below may be, I have been granted 100 shares of options at a $50 strike price. So that means that if I choose to exercise these in the future, I only have to pay $50 per share. Those options are going to vest quarterly. So that means 25 options will vest quarterly. And it's at a fair market value right now of $200. So in this scenario, I would have the ability to buy a stock that's worth $200 for $50. But that $150 discount is called the discount element. And the discount element is taxable to me at the time that I actually choose to exercise the option. Let's look at something that would lead to me exercising it a little sooner. One of the common things that you see with stock options is you have that exercise window. Hey, I'm granting you these options. You have 10 years to decide to actually buy these shares of company stock, unless you leave the company, in which case you'll have 90 days post termination to exercise these options. But you'll also have these things called double trigger protections. And what that means is if two of these events happen at the same time, you can vest these options immediately. You don't have to wait to honor the traditional vesting schedule. An example would be the first event could be a merger or acquisition. My company was acquired by or merged with another corporate entity. The second event could be a layoff. So my company merged with another company, and then I was laid off as a result of the reorganization. That's a double trigger protection, and now I have the ability to not just exercise the options that had already vested. All of the unvested shares are now accelerated, and I can purchase those as well. This is a double trigger protection. Let's look at an example of how this might be taxed. I have the discount element in mind, and I have $100 of shares that I get to buy or exercise as an option. And right now, when I purchase them, those shares are actually worth $150 as fair market value. That means I have a $50 discount for each share of stock that I earn, and that $50 of ordinary income is taxable to me in the year that I purchase the shares. Now, if you have a company that you're really, really excited about that is, poised to increase in value, one way that people will defer these taxes or eliminate these taxes is they'll exercise their options really early. I believe very strongly in this company. I'm going to buy these shares of stock now before the price grows. And I, would still get to pay the same price for my shares, but I'll have to pay more in tax because of the discount that I received. But what's important, regardless of your strategy, when you have stock options, is to not just budget for the purchase of the shares, because you have to buy these shares. You also have to budget for the taxes that are due on the discount value. And this is something that is important as well. Going back to our taxes and our pain points, let's now look at an example with stock options. What's the overall strategy in terms of how we can use stock options for negotiation? Well, the easy one is just like restricted stock, you can negotiate when it comes to stock options at job acceptance, during reviews, and during severance negotiations. At job acceptance, you're really negotiating the options and the vesting schedule themselves. So one negotiation strategy would say you're granting me an option to purchase 1,000 shares. I want an option to purchase 15,000 shares. Another might be you're telling me that these are going to vest annually over a 5-year agreement. I want them to vest quarterly over a 4-year agreement. I want these vesting dates to accelerate so that I can purchase shares at an earlier point. When it comes to severance, it's typically about extending the exercise window. So remember, for most stock options, they're going to give you 90 days post termination to exercise the option. If you're going to negotiate, you might say, I want an additional year post termination to exercise these options so that I'm not also trying to navigate if I can purchase them or missing out on that opportunity at the same time that I'm having to lose a job and look for another one. All of these are negotiation points. And then lastly, when it comes to stock options, you want to consider a funding budget and a funding source to exercise not just the options, but also to pay the taxes resulting from the discount element, the discount you got when you purchased the shares. Next section, section 4, employee stock purchase plans. Employee stock purchase plans, the easiest way to describe these is it's an option to buy shares of your company stock and not pay full price. And if you think about it, if you get even a 10% discount on company stock, and I would say the most typical discount is actually 15%, you're kind of immediately getting a 15% return on your money. If you buy something for $85 and that's worth $100, well, you already got a 15% return on those company shares because you can turn around and sell it for $100. So it's really, really a cool deal. Employee stock purchase plans, they also have a grant date. The vest date is not really as relevant, but with a grant date, it's kind of the date that you actually buy the shares, right? Like here's when I'm actually purchasing them. And if that sounds confusing, the mechanism for an employee stock purchase plan is a little unique. You see, what happens with an employee stock purchase program is there's an offering period. There's a period of time, could be 3 months, could be 6 months, could be a calendar year. And during that offering period, your company is going to take money out of your paycheck, but they're not going to use it to buy the shares when they take the money out. It's literally going to just sit in a pool and wait until the end of the offering period. And at the end of the offering period, they're going to take all of that money and they're going to buy the shares of company stock at that time. Now, the interesting thing is during that offering period, the stock can go up and down, right? If you look at the beginning of the offering period versus the end, you may have said, well, I want a 15% discount on $80. A 15% discount on $100 is not as valuable. So many employee stock purchase plans will have what's called a look back period. And what they'll do is they'll look at the grant date, the value of the stock at the date the offering period began, and they'll also look at the purchase date, the date that these shares we actually purchased, and they're going to apply the discount to the lower of the two. In our example, they would look at the period and they would say, yeah, we bought the shares and the company stock was worth $100 at that time. But when we granted these shares to this person, it was worth $80. So we're going to give them the 15% discount on $80. Now, the value of that discount is going to be taxable to you as ordinary income. And that's something that you have to account for as well. If I have $8,500 worth of company stock that I purchased and it was actually worth $10,000, then on my taxes, it's going to make it look like I earned $1,500. And I have to understand that because if I don't have a mechanism to put aside that money, I'm going to get an unexpected tax bill. So it all depends on your strategy, but the reason that you need to deploy a strategy is because you don't want to get in a situation where you have an over-concentrated stock. Overconcentration, the reason that it's so dangerous is when you look at most people, especially people who have equity compensation, you will find that unless they have a strategy in place to have diversified investments, that their net worth will lay out this way. They'll have a little bit of money in savings, maybe a lot of money in savings, a lot of money in a high yield savings account. So those are cash equivalents that don't really give you a respectable rate of return above and beyond inflation. Then they'll have money in their 401k that they can't access till their 50s or early 60s. And they'll have these non-qualified or non-retirement assets. But the overwhelming majority of those assets will be in company stock. So it's not uncommon for me to look and see a person who's looking at their non-retirement investments and say, hey, 80% of your liquid net worth outside of your 401k is on the backs of literally one company, or 100% of the investments that you have outside of your 401k is riding on the back of one company. And I will ask someone, whether you work at Amazon, whether you work at HCA, whether you work at Alphabet, if you took all your money and you went to the poker table and they asked you to place a bet and you said, I'm placing a bet on the future performance of this company, how much would you bet? Would you bet 100% of your money? Would you bet 80% of your money? Would you bet 20% of your money? Most people wouldn't bet more than 25% of all their money on the future of the company for which they work. But when you look at the layout of their net worth, they have 60, 70% of their net worth sitting in unsold shares of company stock. It is very, very dangerous to have an overconcentration in company stock. So what we encourage people to do is to have a target allocation. We encourage people to think about it with that Vegas mentality. If I went to Vegas and I placed a bet, what percentage of my net worth would I bet on the future of my company? And your answer not only says a lot about how you feel about that company, but it says a lot about the target allocation of your portfolio. If you told me that you would bet 20% of your future on your company's performance, I would say, man, you still really like your company. But you're now saying that when you have company shares that vest, you should immediately sell 80% of those shares. Or a year after they vest, you should sell 80% of those shares for a long-term capital gain. And you should use that 80% to diversify it across a wider range of investments. So for example, you might have a person where if you look, they have 100% of their company stock. They take 20% and they keep it there as their target allocation. They take 50% of those shares and they diversify it across index funds, exchange traded funds, whatever is their fancy. And maybe they put 30% in cash or put 30% towards debts. So when you look at the strategy, they have a strategy where their shares vest and become theirs. They sell the excess allocation. They diversify the excess allocation and put it in the market, or they pay down debt, or they put it towards cash. And they put themselves in a position where they are less leveraged than being over-concentrated with a company stock. Now, here's the bonus to doing this, because some people will look and say, yeah, but, I really do believe very strongly in the company. And I think we're going to go up, twofold in the next 5 years, because I would not lie to you. For a lot of high growth companies, there is better growth potential than putting it across a diversified portfolio, but there's also more potential for bust. And the reason that's important is because you see at this bottom portion, the bonus to having a diversified investment is that diversified investments can be leveraged. I want to give you a scenario to understand what that means. You all may be homeowners. And when you're a homeowner, you're aware of the concept of a home equity loan, a HELOC. A HELOC is a scenario where you have a home that's worth a certain amount, you owe a certain amount, and the gap between the two is your equity in that property. And a lender will give you a home equity line of credit, and they'll allow you to tap into that equity. And when you tap into that equity, you're essentially saying, I can use this over and over again. Some people may use it to get an investment property. Some people may use it to pay off credit card debt at a higher interest rate. It's completely yours to decide what to do with. And what people are unaware of is the fact that you can do the same thing with a diversified investment portfolio. So if you have a diversified investment portfolio of $100,000, you may be able to go to a lender and they may say, we'll give you a line of credit against this portfolio using it as collateral for $50,000 or $60,000. So let's say I have a person that has a $100,000 investment and a $50,000 line of credit against that investment. And they find an investment property and they say, you know what, I think this would be a great Airbnb. I think this would be a great rental. Or maybe in a negative light, they're looking for money to pay a tax bill. They have a $2,000 tax bill that they have to pay that they weren't expecting. Or they need to buy a car and they weren't expecting to have to buy a car. Well, they have a $50,000 line of credit that's sitting there and they have a $100,000 investment account. And some people may look at the investment account and they'll say, oh, I guess I'll just cash out $20,000 and I'll pay for these things. Well, if you cash out $20,000, not only are you going to have to pay capital gains tax on those funds, if you're a high income earner, you might also have to pay something called net investment income tax on those funds. But you also have $20,000 less in the market. So if the market goes up 10, 15% the next year, instead of having $100,000 that's growing at 10 or 15%, you have $80,000 that's growing at 10 or 15%. So it's a consequential decision to sell those shares. Conversely, let's say that I have that $100,000 account and I tap $20,000 of that line of credit instead of selling those shares. Well, most people would look and they'd say, oh, you have $80,000 left. You had a $100,000 account. You borrowed $20,000 from your line of credit. You don't. You still have $100,000 in the market because you're not taking the money from it. You're taking the money using that line of credit as collateral. So it provides a funding source that can accomplish multiple things. In some cases, we have people who have their diversified investment account. They'll open that line of credit and they'll use that line of credit to do things like exercising the stock options that are vesting through their employer. So not only is there an opportunity to diversify and hopefully take the volatility out of your portfolio by selling these excess shares from your company stock, but you also can open up and increase the leverage you can use to have a funding source to go buy more company stock or other investments that benefit you financially.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.